You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi, it's Jake here. Welcome to The Voluntary Life. This week's show is about the topic of investing, and I'm going to be talking about investing in stocks as a passive investor. Now, throughout this talk, I'm going to be assuming that you are a passive investor and that you're interested in following some kind of passive investment strategy with low expenses for the long term. What I mean by that is I'm not going to talk about strategies that involve picking particular stocks which you think are going to perform well, or picking particular stocks that you think are undervalued, or picking particular stocks that you think will provide a good, healthy dividend income to live from, regardless of what happens to the capital value. Those are all different approaches to investing, but they all assume that you're going to become knowledgeable enough about stocks to pick stocks that you think are going to be the right ones to perform well for you, or that you're going to pick some expert who's going to make those decisions for you. And as I've spoken about many times in the past, that's not the approach that I follow. I follow a more passive investing approach, which is to choose index funds that track the performance of the stock market as a whole. So if the stock market overall rises, an index fund is going to benefit from the same amount of rise that the market overall has, but it won't give you the greater returns of those star performing stocks, and it also won't give you the lesser returns of those stocks that perform worse in the market. It's just going to give you whatever the average of the market was. If the market on average goes down, then you're going to suffer those losses as well. But the idea is to track the market as a whole, and that's the approach that I follow. Now, some people who are passive investors put all of their investment into the stock market on the basis that overall companies creating products and services are what generate wealth in the economy, and stocks are your way of owning a portion of that wealth generation process, and this is where new wealth comes from. So even though the stock market is volatile, some people think that if you're in it for the long term, you might as well put all of your portfolio into stocks. That's not the approach that I follow. I have a more diversified portfolio. I'm a private investor, and I follow an approach to investing called the permanent portfolio, as I've spoken about on many previous episodes of this podcast. And that approach invests in 4 different asset classes, and one of the asset classes that I invest in is stocks. And I thought it might be interesting to talk about some of the general issues and topics that face you when investing in stocks. And I'm going to be including answers to some of the questions that were asked by listeners in my private Facebook group for patrons of The Voluntary Life. Don't forget, if you want to support the show and help The Voluntary Life, then you can become a patron on patreon.com/thevoluntarylife. And there's more information about that on my website too, thevoluntarylife.com. And you'll get a whole range of bonus episodes and other rewards. So I should say before we start that I'm not a financial advisor, and obviously the usual disclaimers apply. You have to take responsibility for your own money, and it's up to you what you do with it. But these are just my opinions and my thoughts from what I've learned following a particular investment strategy that was originally developed by Harry Browne in his book, Fail-Safe Investing. And this should be of interest to anyone who is working towards financial freedom, who wants to invest their savings and find a way to live from investments in the future. That's what I've done following the sale of my business. I invested the proceeds of that sale, and I now live from my investments, and I am financially independent, and stocks are an important part of my portfolio. But in order to do that, I had to learn about investing. I didn't know anything about it really before I started investing. So I learned about many different investment approaches, and the one that I settled on is this idea of creating a passive portfolio of different asset classes, and one of those asset classes is stocks. The reason that anyone holds stocks in their portfolio is that stocks generate both dividends, so an income from stocks, you can actually get dividend payments, but they also increase in capital value, so the value of your investment rises over time if the stocks in the companies that you invest in increase in value. And one of the advantages of stocks is that capital gains, like the increase in value of stocks, are not taxed until you actually sell them. So the value of your portfolio can rise without you incurring a tax liability on that capital gain until you eventually sell some of your stocks. But as I mentioned, stocks also generate dividends, and some people even pick stocks purely for the amount of dividends that they generate. The idea being that that provides you with an income. Some people intend to invest in companies that pay out a lot of dividends and then live from the dividend income of those stocks. If you do that, though, you have to pick particular companies based on their price to earnings ratios. And I personally follow an approach which is much more passive, an approach to investing in stocks which says, I don't know which companies are going to do well and which companies are going to do badly. I don't have that much in-depth knowledge of the stock market. So what I want to do is invest in the market as a whole and know that if the market rises overall, I'll benefit from that rise. And people who follow this more passive approach tend to invest in index funds. Index funds buy a range of stocks reflective of the market capitalization of all the companies on the stock market overall. So they buy a collection of stocks that tracks the performance of the overall market as a whole. So one of the first questions that I got from listeners when talking about investing in the stock market is relating to this question of passive investing and how to choose an index fund that you're going to invest in. So if you want to be a passive investor and buy stocks for the long term, you're going to be investing in a mutual fund or an ETF, an exchange traded fund that tracks the market as a whole. So if you are a passive investor and you're going to follow this approach, how do you actually do it? How do you choose the funds that you want to invest in? Well, if you're going to buy into an index fund, it's going to be either a mutual fund or an exchange traded fund, an ETF. So which mutual fund or exchange traded fund ETF are you going to choose? Well, I'm going to talk about some of the factors that I've learned about and that I consider important, and hopefully hearing about my experience will be helpful for you. Now, the first factor that is really crucial to look at is the expense ratio. So if you're investing in an index fund, they're all going to be pretty much tracking the same thing. They're going to be tracking the stock market as a whole. So one of the key differentiators between these funds is going to be how much they charge you as an expense for putting your money into their fund. And this is expressed as an expense ratio. So the expense ratio reflects how much a mutual fund or an ETF pays for portfolio management, administration, marketing, distribution, and other expenses. And you'll almost always see this expressed as a percentage of the fund's average net assets. So they will give you a percentage that you will effectively be charged on your investments in that fund. Now, here's the key. There are low-cost index funds, and then there are the average cost index funds, and the difference between those costs is massive. Your expenses when investing are one of the determinants of the return that you get, and it really pays to be aware of your expense ratio and to find funds to invest in that have a low expense ratio. The fund that really pioneered low-cost investing is called Vanguard, and they're pretty much the market leader in low-cost index fund investing. They started in the United States, but they're also present in the UK and various other countries too. Now, just to give you some numbers for comparison purposes, the industry average expense ratio is about 1%. It's 1.01%. If you do it on an asset-weighted basis, it's less than that. It's about 0.55%. So basically, when you're looking at the industry as a whole, you're talking about an expense ratio of 0.5% to 1% each year, depending on the fund that you invest in. Now, bear in mind, when I've talked about investing before, I've talked about the 4% rule, living off 4% of your portfolio. If you think about this, 0.5% to 1% is a lot of money if you're wanting to live off 4% of your portfolio. So you want to live off 4%, you're already losing 0.5 to 1% of that. That's a big expense. Now, in comparison, Vanguard has an average expense ratio of 0.18%. So it's less than a fifth of the 1% industry average. And Vanguard, on an asset-weighted basis, the average is even lower than that. It's 0.12. So with Vanguard, you're talking about 0.12 to 0.18%. Let's just say, rounding it, that you're talking about 0.1 to 0.2%, whereas on average, you're talking about 0.5% to 1%. So there's a huge difference between low-cost funds and average funds. So the first key issue, if you want to invest in stocks as a passive investor, is finding low-cost funds to invest in. And it's going to depend on the country that you're in, what is available to you, but you want to find something that's like Vanguard in terms of the amount that they charge. Now, that will also depend on what is available on your platform that you're investing in. So depending on which investment broker company you use, you may find that they have Vanguard funds or low-cost index funds on their platform or not. And again, that could be an important issue to look at when choosing which platform you want to invest in, which broker to go with, basically. You also need to look at the fees that the platform is going to charge for things like transactions and overall platform fees. So there are all sorts of expenses in investing that you need to address. And I could go into a huge amount of detail on this, but it does differ from country to country. So the key thing, I think, to take away from this is whether or not you are investing in a low-cost index fund like Vanguard or in one that is more in line with the industry averages that I quoted. Another aspect that you need to consider when choosing an index fund is whether or not you want one of those funds that pays out dividends or automatically reinvests them. And this is another area where it gets kind of complicated because there are tax consequences of both automatically reinvesting and paying out. And so you have to look into this in a bit of detail yourself. To cut a long story short, though, if you're in the stage where you're continuing to invest money in your portfolio, then it kind of makes sense that you would want automatic reinvestment. But if you're living from your portfolio, then it makes sense that you'd want dividends to be paid out. However, another thing to bear in mind is it might not be that easy to switch from automatic reinvestment type portfolios to portfolios that pay out dividends. You might have a tax liability if you have to sell your stocks and buy into a different fund. So you need to look into this yourself. It's a bit too detailed to go into on this podcast, but that's another consideration to take into account when choosing an index fund for stocks. Another question that I got about investing in stocks is, should you invest in your own country's stocks or in an international fund covering multiple countries? So should you buy stocks from the country you are in or from another country or from a whole pool of countries? And this is a really interesting question about geographic diversification. As I mentioned, I follow an approach called the permanent portfolio. And part of that approach does involve investing in some international assets like gold, for example. So I don't invest in stocks from other countries. The stocks that I invest in are from the UK. That's the approach that I take. And there's a number of reasons for that. One is that that's the currency that I earned my money in. And because I am holding different asset classes to hedge against changes in the UK economy, it makes most sense if I hold stocks in the UK too, because that's part of my strategy, is to hold asset classes that will perform differently depending on what happens to the UK economy. So that's the approach that I follow. I know that a lot of people who invest 100% in stocks, they realize that they've got this risk of being wholly based in one country. So some of them split between stocks in their own country and then stocks in some kind of international fund. That's a different approach. And I think if you're going to do that, you have to think about what strategy you'll use to determine the split of your international mix. I personally am not changing my UK-based permanent portfolio until such time that it's obvious that I'm really spending my whole time spending money in a particular different currency. So let's say I move to Canada in future. And when we decided we were going to live in Canada for years and years and years, and we were spending Canadian dollars all the time, then it would actually kind of make sense to look at whether or not I should switch from a UK portfolio to a Canadian one. But since we're moving around and going to different places, there's not that much point in me changing my portfolio from UK to, say, for example, European stocks. We're currently in Spain, but we're only going to be here for a while. So it doesn't really make any sense for me to go through all the expense and upheaval and tax liability of making all those changes again and again. So basically, I'm in the UK. I'm diversified by other means, like buying international assets like gold. But if you're not going to buy other types of assets, then you do have to think about your own strategy for international diversification. Investing is one of those areas where you have to learn a lot of stuff, and it's very easy to get duped, and it's very easy to go wrong and make bad decisions. And I'm certainly not an investment expert, but I am somebody who's had to learn all this stuff themselves. And so what I'm doing is sharing with you my experiences about learning how to choose stocks to invest in. And hopefully you can benefit from hearing about my experiences. This is a huge topic, and there's lots more that I could say about investing in stocks, but I think we're going to leave it there for this week. So we've just covered some of the issues about choosing index funds to invest in, and I hope that's helpful. I'd love to hear your feedback. Let me know what you think. That's all for this week. I'll be back next week with another episode. In the meantime, I hope you have a great week.
Thank you for listening to The Voluntary Life. If you like this podcast, please show your support by becoming a patron of The Voluntary Life on Patreon. Your support will help to grow and improve the show, and you'll get access to a treasure trove of rewards, including bonus episodes. Visit thevoluntarylife.com to learn more.